In the sweltering summer of 1929, Joseph Kennedy, the father of future President JFK and one of the wealthiest men in America, stopped at a shoe shine stand in lower Manhattan. The air in the city was electric. You could feel it on the pavement. Stocks had been going up for 5 straight years. Taxi drivers, cooks, and doormen were all getting rich. The common belief was that America had reached a permanently high plateau of prosperity. The boy polishing Kennedy's shoes didn't just talk about the weather. He looked up, his face smudged with polish, and gave the millionaire a stock tip. He said, "Buy RCA, sir. It's going to the moon. I just bought 10 shares on margin." Kennedy smiled, tipped the boy a quarter, and walked straight into his broker's office. The noise in the brokerage was deafening, men shouting orders, tickers clicking, champagne corks popping. But Kennedy didn't buy RCA. He didn't buy anything. He walked up to his broker and gave a command that silenced the room. "Sell," he said. "Sell everything." He liquidated his entire portfolio. Every stock, every bond, every speculative position. He moved 100% of his massive fortune into cash. When his friends asked him why he would sell during the greatest economic boom in human history, Kennedy reportedly said, "When the shoeshine boys are buying stocks on margin, the market is too popular for its own good. There is nobody left to buy." 6 months later, the music stopped. On Black Tuesday, the market fell 12%. By the end of the week, it had collapsed. The Great Depression wiped out the Rockefeller fortune, the Vanderbilt fortune, and the life savings of millions of Americans. But Joseph Kennedy didn't just survive. Because he was holding cash when asset prices collapsed, he was able to buy up America for pennies on the dollar. He bought real estate, movie studios, and oil wells from desperate sellers who had no choice but to liquidate. He doubled his fortune while the rest of the country starved. History remembers the shoeshine boy story as a lucky anecdote, but that is a lie. Kennedy didn't sell because of a gut feeling. He didn't sell because of a shoeshine boy. He sold because he recognized a mechanical signal, a signal that flashes right before the credit cycle breaks. And right now, in late 2025, that exact same signal is flashing again, but this time, it's not Joseph Kennedy. Warren Buffett is currently sitting on a record $381 billion in cash. It is the largest war chest in the history of corporate America. He has been a net seller of stocks for 7 straight quarters. Jeff Bezos has sold over $18 billion in Amazon stock since the start of 2024. Jamie Dimon, the CEO of JP Morgan, the most powerful banker in the world, recently sold shares for the first time in his entire tenure at the bank. They are heading for the exits. The media tells you this is just diversification. They tell you the economy is strong. They tell you that AI changes everything. They are lying to you just like they lied in 1929. The smart money is selling because they know the cash event is coming. In this video, I'm going to show you the math behind their exit. I will show you the 3-stage pattern they are following, the same pattern used by Paul Tudor Jones in 1987 and Michael Burry in 2008. And most importantly, I will show you how to position yourself so that when the crash comes, you don't just survive it, you profit from it. The cash signal. To understand why the collapse is guaranteed, you first have to understand what Warren Buffett is actually looking at. Most people think Buffett is just a nice old man who drinks Coca-Cola and buys good American companies. They think he holds stocks forever. But the real Warren Buffett is a ruthless mathematician. He doesn't care about narratives. He cares about return on invested capital. And for the last 2 years, his math has been screaming one word: stop. As of November 2025, Berkshire Hathaway is sitting on $381.7 billion in total cash and short-term treasuries. Let me put that number in perspective for you. That is more cash than the GDP of Denmark. It is more cash than Apple, Microsoft, and Google hold combined. Why? Why would the greatest investor in history hold depreciating cash during a roaring bull market? He told us why in his 2024 shareholder letter, but almost nobody listened. He said he cannot find anything attractively priced. In plain English, everything is a bubble. This brings us to the most accurate recession predictor in history, the Buffett indicator. This is a simple ratio that anyone can check. It takes the total market cap of the US stock market and divides it by the US GDP. If the result is 100%, stocks are fairly valued. It means the market is priced in line with the economy. If it hits 120%, stocks are overvalued. This is the danger zone. In 2000, right before the dot-com crash destroyed the NASDAQ, the Buffett indicator hit 140%. At the time, that was considered impossible. In 2025, it is sitting at 185%, closing in on double the size of the entire US economy. Let that sink in. The stock market is nearly double the size of the actual economy. We are higher than 1929, higher than 2000, higher than 2008. Buffett knows that this line always reverts to the mean. It is a mathematical certainty. Gravity applies to finance just like it applies to physics. And when it reverts from 195% back to 100%, that isn't a correction. That is a 50% collapse. But it gets worse. Buffett isn't just not buying, he is actively dumping his favorite stocks. For decades, Buffett loved Bank of America. He called it a wonderful business. He stood by it during the 2008 crisis. Yet in late 2024 and throughout 2025, he sold over 100 million shares of it. He slashed his Apple position, the crown jewel of his portfolio, by nearly 50%. When you sell the safest company in the world and one of the biggest banks in the world to hold treasuries, you are making a very specific bet. You're betting that cash is about to become the most valuable asset on earth. In the finance world, we call this a liquidity event. Right now, cash is trash. Inflation is eating it away. But in a liquidity event, when the bubble bursts, credit disappears, banks stop lending, buyers vanish. In that moment, he who has the cash makes the rules. In 2008, when Lehman Brothers collapsed, nobody had cash. Goldman Sachs was begging for money. General Electric was days away from missing payroll. Who had the cash? Warren Buffett. Because he sold early, he was able to walk into Goldman Sachs and lend them $5 billion. But he didn't lend it at a normal rate. He demanded a 10% interest rate plus warrants to buy stock at rock bottom prices. He didn't just buy the dip, he bought the bank. That is what stage one of the pattern looks like. You don't try to time the exact top. You exit early. You look foolish for 12 months. You sit on the sidelines while your friends brag about their Nvidia gains or their crypto spikes. You let them call you scared. Because you know that when the Buffett indicator snaps back, those gains will vanish in 48 hours. But Buffett isn't the only one preparing. If we look at the tech sector, the insider exit is even more aggressive, and the specific stocks they are selling tell us exactly where the crash will start. The insider exodus. If Warren Buffett was the only one selling, you could argue he's just being a cautious old man. But he isn't alone. The most aggressive insider exit in history is happening right now in the tech sector. And when you look at who is selling, you realize they aren't selling because of tax reasons. They are selling because they know their customers are about to go broke. Let's look at Jeff Bezos. In 2024, Bezos sold roughly $13.6 billion worth of Amazon stock. Then, in mid-2025, he sold another $5.7 billion. That is nearly $20 billion in cash raised in less than 24 months. Why? Amazon is a dominant company. It owns the cloud. Why flee? Because Amazon's biggest growth engine isn't you buying toothpaste, it's AWS. And who pays for AWS? Startups. Tech companies, corporate America. Bezos has access to real-time data that we don't. He can see if cloud spending is slowing down. He can see if startups are missing their payments. He knows that if the economy hits a wall, the first thing companies cut is their cloud bill. He is front-running the corporate recession. But he's not the only one. The Walton family, owners of Walmart, sold $4.5 billion in stock in 2024 alone. It is a systematic liquidation. They are the best barometer for the American consumer. When the Waltons sell, it means the average American is broke. Mark Zuckerberg sold millions of shares of Meta throughout late 2024 and 2025. This is what we call the smart money consensus. When the richest retailer, the richest tech founder, and the richest investor all go to cash at the same time, they are looking at the same ticking time bomb. And that bomb is hiding in plain sight. It is the specific trigger that will cause the 2026 crash. It's not crypto, it's not the stock market, it is the building you are probably sitting in right now. The trigger for the 2008 crash was residential real estate. It was driven by strippers in Miami owning 5 condos they couldn't afford. The trigger for the 2026 crash will be commercial real estate. It is driven by private equity firms owning office towers that nobody uses. Here's the math that is terrifying the banks. Right now, in late 2025, nearly $1 trillion in commercial real estate loans are maturing. By the end of 2026, that number jumps to over $1.6 trillion. These loans were taken out 5 or 10 years ago when interest rates were basically zero. It was the era of free money. Now, these building owners have to refinance, but they can't refinance at 3%. They have to refinance at 7% or 8%. And here's the problem. The buildings are empty. The national office vacancy rate is hovering near 20%. In cities like San Francisco, it is over 26%. In downtown Los Angeles, it's closer to 30%. A building that is 30% empty cannot pay an 8% mortgage. It is mathematically insolvent. The rent coming in doesn't cover the interest going out. This isn't a theory. It has already started. In 2023, Brookfield, one of the largest and most sophisticated real estate owners in the world, defaulted on major office towers in Los Angeles. They didn't negotiate. They didn't try to extend the loan. They simply stopped paying the mortgage and handed the keys to the bank. In San Francisco, a tower that sold for $300 million in 2019 recently sold for $60 million. That is an 80% loss. When the biggest players in the game decide to walk away, you know the game is rigged. But here is why this crashes the entire economy, not just landlords. Who lent them the money? It wasn't JP Morgan or BOA. The big banks are smart. They saw this coming and reduced their exposure years ago. The people holding the bag are the regional banks. Small and mid-sized banks hold nearly 70% of all commercial real estate loans in America. There are currently nearly 100 banks in America, mostly regional banks, that have more than 50% of their assets tied up in commercial real estate. This is the doom loop. 1, the landlord defaults on the building. 2, the bank takes the building back. 3, the bank tries to sell the building, but nobody wants it. 4, the bank has to mark down the value of its assets by 50% or more. 5, the bank becomes insolvent. When these building owners default in 2026, those banks don't just lose money, they fail. And we aren't talking about 1 or 2 banks. We're talking about hundreds of banks failing at the same time. When that happens, the credit system freezes. Small businesses can't get loans to buy inventory. Construction projects stop. Payrolls stop. Unemployment spikes from 4% to 8% in a matter of months. That is the liquidity event Buffett is waiting for. He knows that in 2026, there will be a fire sale of American assets. Banks will be selling loans for pennies. Real estate will be auctioned off. And because he has $381 billion in cash, he will be the only buyer in the room. So how do you play this? You don't have billions, but you can use the exact same strategy. It is called the 3-stage pattern, the mechanical pattern. If you study every major crash of the last 100 years, 1929, 1987, 2008, you will see they all follow the exact same mechanical sequence. It is not random. It is a script. Most people think crashes are chaotic events that happen out of nowhere. A black swan, they say. But to the smart money, a crash is just a transfer mechanism. It is a machine that moves wealth from the impatient to the patient. To prove this to you, I want to take you back to 1987. In the 1980s, there was a trader named Paul Tudor Jones. He wasn't famous yet. He was just a guy running a hedge fund in New York. While everyone else was celebrating the roaring bull market of the 80s, Jones noticed something disturbing. He laid a chart of the 1980s stock market over a chart of the 1920s stock market. They were identical. Every rally, every dip, every fluctuation matched perfectly. The human psychology of greed was repeating itself tick for tick. Jones realized that if the pattern held, the market was going to crash in October 1987. His colleagues told him he was crazy. They said, "Times are different, Paul. We have computers now. We have safeguards." But Jones trusted the mechanism. He bet his entire career on the crash. He shorted the market aggressively. On October 19th, 1987, Black Monday, the Dow Jones fell 22.6% in a single day. It was the largest one-day crash in history. Traders were crying on the floor of the exchange. Fortunes were vaporized in hours. But Paul Tudor Jones didn't cry. He made $100 million that day. He tripled his money while the world burned. Why? Because he had the script. Right now in 2025, we are following that same script. We are currently in the transition between stage 1 and stage 2. Stage 1, the exit. This is where we are today. The goal in stage 1 is not to make money. It is to not lose it. This is the phase where the smart money liquidates risky assets. They are selling stocks that are trading at 50 times earnings. They are trimming their winners. They are moving capital from risk on to risk off. If you are currently holding speculative tech stocks, meme coins, or companies that make no profit, you are currently the exit liquidity for Jeff Bezos. He is selling to you. Your job in stage 1 is to audit your portfolio with brutal honesty. Ask yourself, if the stock market closed for 5 years, would I be happy owning this company? If the answer is no, sell it now. Raise cash. Because when the liquidity event hits, you won't be able to get out at these prices. Stage 2, the hedge. This is what happens next. As the smart money raises cash, they don't just put it under a mattress. They buy insurance. In 2008, the big short investors like Michael Burry bought credit default swaps. They paid a monthly premium to insure against the housing market collapsing. For 2 years, they looked like idiots. They lost money every month on premiums. But when the collapse happened, those insurance contracts paid out 50 to 1. In 2026, the hedge looks different. You can't easily buy credit default swaps on commercial real estate unless you are a hedge fund. But there are 2 assets that act as the ultimate insurance policy for the common man: gold and volatility. This is why central banks bought over 3,000 tons of gold between 2022 and 2025. That is a record. Why are China, Russia, and even Poland buying gold like it's going out of style? Because they know the only way the US government solves a $38 trillion debt crisis is by printing money. When the regional banks fail in 2026, the Federal Reserve will have a choice. Option A, let the banking system collapse. Option B, print $5 trillion to bail them out. Politicians always choose option B. They always choose inflation. When they turn on the money printer, the dollar loses value. Gold skyrockets. Stage 2 is about owning hard assets that cannot be diluted by a politician's signature. Stage 3, the re-entry. This is the hardest stage. This is the Kennedy stage. When the crash happens, likely in mid to late 2026, the news will be apocalyptic. You will see headlines like, The end of capitalism. Great Depression 2.0. Unemployment hits 10%. Your friends will be panicking. Your family will be terrified. Your instinct will be to run and hide. But that is when you must be aggressive. The cash you raised in stage 1, you deploy it now. You buy the S&P 500 when it is down 40%. You buy high-quality companies like Amazon or Microsoft when they are trading at 2015 valuations. You buy the assets that the bankrupt regional banks are forced to liquidate. Joseph Kennedy made $50 million because he had cash when everyone else had debt. Warren Buffett made $10 billion on Bank of America because he had cash when everyone else had fear. The window to execute stage 1 is closing. You have maybe 6 months before the maturity wall hits the real estate sector in 2026. The billionaires have already made their move. The question is, have you? The 2026 battle plan? So we know the who, we know the why, and we know the when. The final question is, what do you do right now? You are not Warren Buffett. You don't have a direct line to the Federal Reserve Chairman. You can't call up Goldman Sachs and demand a special deal. But you have one massive advantage that Warren Buffett doesn't have: agility. Buffett has to move $381 billion. It takes him months to enter or exit a position. He is an elephant trying to hide in a bathtub. You are a speedboat. You can move your entire portfolio in one click. Here is the 3-step battle plan to survive the cash event and build generational wealth. Step 1, the liquidity audit. The first thing that happens in a liquidity crisis is that credit freezes. In 2008, banks slashed credit card limits overnight. HELOCs were frozen. Even people with good credit scores were told no. If you are relying on credit cards or loans as your emergency fund, you are vulnerable. If you have a business that relies on a line of credit to make payroll, you are vulnerable. Your goal for the next 3 months is to build a fortress balance sheet. Reduce your high-interest debt. If you have credit card debt at 22%, pay it off now. That is a guaranteed 22% return on your money tax-free. No stock in the world offers that risk-free return. The smart money is holding 20 to 30% cash. If you are 100% invested in stocks, you have no bullets left for the war. You need dry powder. Because when Amazon drops 50%, it doesn't matter if you know it's a good deal if you don't have the cash to buy it. Step 2, the hard hedge. While you hold cash to buy the dip, you need insurance against the government's response. Because remember, when the crash hits, the government will panic. They will print trillions. This debases the currency. If you hold 100% cash, you are betting that the government won't print money. That is a losing bet. This is why central banks are buying gold. They are hedging against their own incompetence. A standard crisis portfolio allocates 5 to 10% to hard assets: physical gold, silver, Bitcoin. These are assets that have no counterparty risk. If a bank fails, your stock portfolio might be frozen. But a gold coin in your safe is still a gold coin. A Bitcoin in cold storage is still a Bitcoin. These are your insurance policy against the dollar losing purchasing power during the inevitable bailout phase. Step 3, the shopping list. This is the most important step. Most people freeze during a crash because they don't know what to buy. They get overwhelmed by the negativity. You need to write your shopping list today while you are calm. Identify 3 to 5 high-quality companies that you wish you owned but are too expensive right now. Maybe it's Microsoft, maybe it's Visa, maybe it's Costco. Write down the price you want to pay. If Costco is trading at $800, maybe your buy price is $500. Write it down. Put it on a Post-it note on your monitor. When the panic hits in 2026 and Costco drops to $500, you don't hesitate. You don't read the news, you execute the trade. That is how generational wealth is built. It isn't built by day trading. It is built by buying quality assets from distressed sellers during a liquidity event. The choice. We are living through the end of a long-term debt cycle. These cycles only happen once every 80 years. The last one ended in 1945. The one before that ended in the Civil War. We are due. The signs are everywhere. The Buffett indicator is at 185%. Commercial real estate is defaulting, and the richest men in the world are cashing out. You have 2 choices. Choice A, you can ignore the data. You can listen to the news anchors telling you everything is fine. You can stay fully invested and hope for the best. If you do that, you will likely suffer the same fate as the average investor in 1929, watching 80% of your wealth evaporate in 6 months, and then selling at the bottom because you can't take the pain anymore. Choice B, you can prepare. You can follow the smart money. You can raise cash, hedge your risks, and wait for the opportunity of a lifetime. The crash is coming. It is mathematical. It is mechanical. And it is inevitable. But it doesn't have to be a tragedy. For the prepared, it is the greatest opportunity in history. I will be tracking this cycle every single week on this channel. I will tell you exactly when the insider selling accelerates. I will tell you when the credit spreads begin to widen. And I will tell you when the buy signal finally flashes. If you want to survive the 2026 event, make sure you are subscribed and have notifications turned on. The insiders have made their move. The clock is ticking. Now, it's your turn.